right, good morning. Good afternoon. um, Long day. I know investors are a little bit on edge because, well, first and foremost, we have not had a 3, 4, 5% correction for the S&P 500 in more than 80 trading days. So when you get a kind of pullback like we're having here today in the market, which and I don't want to jinx anything, but we are well off of the worst levels of the session. We were down about 55, almost 60 points in the S&P 500 at the lows, and we were down more than 200 points in the NASDAQ at the lows. So like I said, I don't want to jinx it, but point being, when you get one of these kinds of pullbacks right at the open, investors start to believe that, okay, here comes that 3, 4, 5, maybe 6, 7% correction consolidation that everybody has been basically forecasting for the last couple of months. So welcome back. My name is Seth Golden. This is Phenom Group. I'm going to run through some charts and some what I think is relative data here as we kick off the second half of the year. Hopefully I can get it done within a half hour, but we'll see how that works out. For our Phenom Group members, and as always, if you are not a Phenom Group member, if you do not receive our weekly State of the Market video and our weekend macro market research report, won't you give us a try? Subscribe here at Phenom Group. You can get our State of the Market weekly videos and our macro market weekend research report for just $14.99 a month. If you want to trade, invest with our ideas and strategies, upgrade to the Phenom Group Premium membership for $59.99. That's basically, you get everything. All right, so here's a tweet that I had offered back on January 30th of this year. And as I state, this literally happens every single cycle because human behavior is the most constant variable in markets and investing. The only question is not if it's going to happen, but when it's going to happen. So again, this was the beginning of the year. We got off to a really good start. January trifecta. What's the January trifecta? For those of you not familiar, January trifecta is when the first 5 trading days of the year are positive. When the January barometer is positive and the Santa Claus rally is positive, meaning all 3 of those deliver a positive S&P 500 return. So we got off to a great start this calendar year. And I said, well, how do you trap a bear? So let's blow this up so we can all see it. Here's how you do it. Have the longest and deepest bear market without a recession. Have the Fed hike rates to fight inflation at the fastest pace in 40 plus years. Have the equity risk premium shrink the most in more than a decade without a recession. Disinflation sets in for over 6 months as rate hikes start to slow. Have a short and shallow recession for which inflation and yields fall further. And again, all of this happened, folks. Watch the equity risk premium improve as EPS can't keep downside pace with disinflation and the yield cycle. Treasury yields. Watch the low PE of the former bear market, and the low PE was about 15 times forward S&P 500 earnings last year. But watch the low PE of the former bear market prove the low PE as the equity risk premium keeps rising. Watch as the bears pound the picnic table about PEs expanding while in a recession, which it has done 89% of the time since 1950. In other words, you get multiple expansion at the beginnings of a new bull market. All of this happened. This is how you trap a bear. And a lot of them are still trapped. They still believe we're going back to the former lows. It's kind of a warning. Like, nobody can say I'm not a nice guy. The bears cannot say that I'm not giving them every bit of a heads up. All right, and here's a great piece from Neil Dutta, who is the chief economic strategist at Renaissance Macro Research. He generally writes a piece for the Business Insider maybe once every month to 2 months. But when he does, and I've linked it here for our Phenom Group members so you can check it out. But here's an excerpt. He's basically singing my tune. Wall Street analysts and economists have always had a tendency to fall in love with their forecasts. They don't like to admit when they're wrong. And even as the evidence against them piles up, many stick to their guns. This stubbornness helps explain why Wall Street is having an exceptionally hard time letting go of the idea that a recession is just around the corner. I interjected here with Mike and Mike, Mike Wilson and Mike Cantrow. Right? Those are two of the most bearish strategists on Wall Street right now. Mike Wilson from Morgan Stanley still believes the S&P 500 will go down to 3,200, maybe 3,300 by the end of the year. And Michael Cantrow says the same thing, 3,200 by the end of the year. I'm not saying it's not possible. I'm saying the probabilities are very low. The probabilities are very low. But more to Neil Dutta's point in why he wrote this is, at what point do you just admit you had it wrong? As the forecasts for recession keep failing to come true, the explanations for this delay are always explained away. Strong jobs growth. It's late cycle sign that the end is nigh. Rally in U.S. equity markets. We had a big rally in mid-2008 too. Housing picking up. It's only because inventories are low. Like, they'll explain everything away. Really great piece. I encourage everybody to read it, and follow Neil Dutta also in Renaissance Macro Research on Twitter. They always put out some really good stuff. And look, you want to be fair, right? So I was wrong last year. My price target for the S&P 500 last year, I think, was 5130, something like that. And I was wrong. I still did well. We still managed very well here at Capital Ladder at Phenom Group because we maintained our discipline. We kept a lot of cash on the sidelines, and we executed a game plan. If the S&P 500 got here, if the NASDAQ got here, this is where we would allocate some of that cash. And lo and behold, that discipline, that buy the dip, buy the correction, buy the bear market mentality. Don't look away. Don't run away from the market, but stick with the market, has proven to compound the gains into this calendar year. But just like I was wrong with my price target last year, so was Fundstrat. It's just a reversal this year. The bears are wrong. See, here's the thing, though. It's okay to be wrong and be bullish, because we know what's going to happen to the market eventually. It's going to recapture the uptrend. The problem with being wrong and being bearish is it may take years and years and years in order to recapture the downtrend and have a bear market that gets you back to maybe where you started, which is extremely rare. Some gaps don't fill. All right, but this was Fundstrat, Tom Lee of Fundstrat, his where he thought the S&P 500 would be for 2023. 5,100 with the 20 and a half times PE. Earnings of $250 a share. None of this came to fruition. Nobody's perfect. But you still want to be aligned with the long-term trend, not hoping you catch a bear market, not hoping for the inevitable. Because bear markets are inevitable. The problem is they're rare. To try and time one is just a poor discipline. To take advantage of one by buying the dip, buying the correction, that's just good, savvy investing. All right, here's another chart I want to check out from 314 Research, my friend Warren Pies, another fantastic firm. Warren Pies is one of the best strategists and technicians, sell-side analyst that I know. He does great work. One of the things, though, that I've recognized in our collaborations, just our exchanges and whatnot, is that it's really critical. It's really critical that people understand where we are in the macro market cycle. And when I saw this chart within one of their reports and on Twitter, So you can check it out. Just go to @314 Research. And what he's showing here is that if we're assuming October was the low last year on an equal weighted basis, equal weight S&P plus 14% since the October lows. That's this bottom squiggly line right here, the dark shaded one. So this is the worst, the absolute worst performance for the equal weighted S&P 500 off of a market bottom. But what I think the problem is here is we are not recognizing where we are in the cycle. See, most people think, well, the bear market's over. You have a new bull market, so you have a new cycle. And yeah, usually that's how it works. I'm of the opinion, though, that the market characteristics are still saying that the cycle low was 2020. And that 2022 was just a major equity risk premium repricing correction that exuded bear market characteristics, but it's a continuation of the new bull market from 2020. And here's why I say that. And most of you have seen this chart before. The top is 2009. The market bottomed in March of 2009. This is the equal weight versus the cap-weighted S&P 500 index ETF. Top chart. Bottom, March 2009. Equal weight outperforms upward trending slope here is the equal weight outperforming the cap-weighted index ETF. For 28 months, and then it collapsed and broke the upward sloping trend line. Well, guess what? September of 2020 is when this performance ratio bottomed. Equal weight versus cap-weighted S&P 500. 28 months later, just like the last time, 28 months later, breaks below the trend line. It's a continuing cycle. It's not a new cycle, but most are of the opinion that this is a new cycle. We didn't have a recession. That's also another reason why this is not a new cycle. When we look at this chart and we see that this is the worst performance for the equal weighted S&P 500 off of a bear market low, you know what other time was it? So before this occasion, the worst equal weighted S&P 500 performance off of a bear market bottom was 2018. And lo and behold, no recession that year either. You had a technical bear market. In 2022, we had a technical bear market without a recession also. So it just so happens to be that for both of these bear markets without a recession, they had the worst performances for the equal weighted S&P 500 off of the bear market low. It's because you had a continuing cycle, not a new cycle. These are the nuances. These are the nuances that you want to understand because they'll help you to allocate your capital better, maybe to the appropriate areas of the market, or more appropriate, I should say. How do we know? We've gone over this before. How do we know that we were pricing a recession last year that still has yet to materialize? Because consumer discretionary does poorly 12 months up to the recession. The average 12-month performance before a recession is negative. 6 months before a recession for consumer discretionary, negative. 3 months before, average performance is negative. How do we know we're not in a recession today in that we have priced one because of the negative performance then and because of the positive 3, 6, 12-month performance thereafter? The actual recession. It's not our fault that we didn't go into a recession, but we know we priced one based on how poorly consumer discretionary did last year. Why do I bring this up? Because we looked at this chart in the past, or this table in the past, of how the consumer discretionary sector report performs 12 months before and 12 months after a recession. Because this chart right here is also gives you an idea of where you are in the cycle, what may have already been priced versus what's being priced here in 2023. Payers or dividend payers versus non-dividend payers entering recession on average. If the recession starts here, typically the payers, if we use this as a performance ratio, payers outperform non-payers. Payers upward sloping against non-payers up to the recession. After the recession, relatively flat for many, many months, and then a big underperformance, but mostly flat. Why? Because if we're not in a recession, even dividend payers will get their normal allocation. But leading up to a recession, they greatly and continuously outperform. Look at this table below here. We can see event dates, in the past and from past recessions, the 1973, 80, 81, 90, 2001, 2007, and 2020. So after a recession, so 1 month after a recession, it's a coin flip. 50-50 chance that dividend payers will outperform non-dividend payers. Almost the same the entire way until the 12-month period. But it's a coin flip here. This is from Ned Davis Research and their chief equity strategist, Ed Clissold, and he discusses basically what is it going to take for dividend payers, which have underperformed this year, to outperform non-dividend payers. What's it going to take for the dividend payers to come back to life? And he says the short answer is that FanMag stocks need to fall out of favor. A moderation of the stock market uptrend, a worsening economic outlook, which based on today's payroll data, that's not happening, and the ISM as well as S&P service sector data, that's not happening, and a continued Fed tightening should benefit low beta dividend payers. We know that the Fed has it's based on the data, they want a looser labor market. And the existing payroll data that we are achieving week after week, month after month, is saying that the labor market's still very tight. Now, if I believe that if the Fed had its choice, it would rather have a good labor market, which is somewhat tight, with a strong confidence that the disinflation process is firm and will get, the CPI, the PCE will get to their 2% target by the end of 2024. Unfortunately, right now, the Fed is operating, I think, in a state of fear that they don't have it firmly under control. The strength of the labor market, I believe they're of the opinion that is holding the sticky areas of inflation firmly entrenched. They don't believe it's dropping fast enough, the core inflation. So more than likely what we could see is another rate hike at the July meeting. Right now there's a 92+% probability that the Fed will hike at the July meeting, end of this month. Things can change with next week's release of the CPI data. This can change. If we get a bigger drop in the core consumer price index next week on Wednesday, this will probably edge lower. We'll probably get a lot less probability for that 25 basis point rate hike at the July meeting. But for now, with the labor market data coming in so strong, this has risen to 92% probability they'll hike rates. All right, let's get back to it. All right, we've seen a lot of charts so far as in quantitative data regarding, well, if you did this well in the first half of the year, this is the probable return in the second half of the year, and the positivity rate. How often is the market positive in the back half of the year, predicated on how positive it was in the first half of the year. But I want to add another wrinkle to that kind of quantitative data. And this is from Bank of America's Global Research Department. The S&P 500 second half, which we're in right now, the second half and full year returns after an above average first half, and obviously we had an above average first half of the year, but following a down year. That's the wrinkle. Not just did you have a good first half of the year and how, the market performs after a good first half of the year, but did you have a good first half of the year? And what was the result of the prior calendar year? Last year was a down market year. And we had a good first half of the year. And when that happens, the second half returns almost an 86% positivity rate. And the average return is 11%. Don't like averages? You like the median? That's a little more than 11.5%. But more importantly, if we were just looking at how the first half of the year did, only 82% of the time the market is positive in the second half of the year. But if you add this wrinkle following a down return year, you get up to nearly 86% positivity rate in the second half of the existing calendar year. Not bad, right? What about the full return for the next year? Next year has always been positive, 100% of the time. Like, in order for us not to have a positive return in 2024, the Fed's got to really screw this up, because everything is shaping up to engineer a soft landing. And all of the quantitative data is suggesting that the bull market that started the beginning of this year, or since we do have a 20% return off of the October low, it actually started, at that October low. But the market is bullish because it doesn't see a recession, even though the Fed has hiked at the fastest pace in history. I love this quantitative study from Wayne Whaley. This is a really good one because it takes, some of the first half of the year and leads us into the month of July. How will July perform? There's a lot of studies that show July tends to be one of the best months of the year for the S&P 500. This is called the June swoon and midsummer rally. It takes a look. This first column here is March 19th through June 19th. That's the setup. Okay, that's the setup quarter. March 19th through June 19th. And we had a 12.59% return during this setup period. Now, historically, when you get that kind of setup, here's what they call the June swoon. And that starts on the 19th and ends on the 27th. Let's go see. Let's go to 3-month chart. We want to go to, let's get that. Going to the 19th. Did we swoon? We did. From the 19th to the 26th, we were down. Market was down. Here we were on the 17th. It was down about 1%. Down 1%. So history repeating, we got the June swoon, which usually, and it starts on the 27th. So this is from June 19th to the 27th, 27th of June to the 23rd of July. You have the midsummer rally. Here's the setup. Here's the swoon. Here's the rally. When you've had these two, you usually get 19 out of the last 22 occurrences that you had a setup and a swoon. 19 out of the last 22 occurrences, the market was positive between, you had a positive return between June 27th and July 23rd. So what are we looking for? The 27th, you would be looking for, where was the market? 43.78. So by July 23rd, if this is going to be another positive occurrence, we would need to be 43.78 or better. Is it possible that we won't be? Yeah, clearly. 3 occurrences where the market didn't deliver a positive return. The last time was 2004, 20 years ago, basically. What are the probabilities? The probabilities are in the bull's favor. Good seasonal data there, folks. All right, let's look at the VIX. This is from Nautilus Research, another really good study here. I've kind of color-coded it so I can actually see it. Since I'm colorblind, I need a light and dark shade separation so I can see the data. The VIX fell below 1350 for the first time in at least 6 months on June 21st, below 1350. The S&P was 43.65 on that date. So what happens when the VIX crosses below 1350 after being above VIX at 20? What happens when that happens? It goes from 20 to below 1350 for the first time in at least 6 months. The forward returns for the S&P 500 a week later, not that good. 5 times up, 5 times down. Average return was negative. 2 weeks later, again, it's close to 50-50 here. 1 month later, now we're talking. 2 months later, perfect. The market has never been lower. And again, we were 43.65. So 2 months from now, if this holds true, the market should be higher than 43.65. Again, your date of origin or genesis for the signal was June 21st. Market date or signal, 43.65. 2 months from now. So July, August 21st, and that's probably around the Jackson Hole Symposium. The market should be higher than 43.65 if we're looking at this data. 6 months later, same thing, perfect. 3 months later, only one failure. We got a couple studies here, folks, that tell us we should be looking at a stable, if not continued uptrend in the market. Here's another study that I like from Sentiment Trader via Macro Ops. This is looking at a similar kind of volatility breakout here. We had Bollinger Bands, right? These are the Bollinger Bands width, became more than twice as volatile recently as the S&P 500 broke out. So we had an expansion in the Bollinger Band widths. And when this happened, so the S&P 500 after breakaway Bollinger Band momentum with the first high in at least 3 months, what are the returns? What's the positivity rate? I always go and look at that. 67, 67, 1 month later, 67, 2 months later, 67%. I like 70 percentiles or better. That gives me something to lean into. Anything that has less than a 70 percentile rate, I need to look at other data. Nonetheless, 6 months later, 100% of the time, the market was higher than the signal date occurrence. Good stuff. So keep that in mind. I see this chart going around so much right now. It's ridiculous. AI-related stocks. This is from Societe Generale or SG, SocGen. AI-related stocks drove virtually all of the S&P 500 return this year. And what the chart suggests is that if you X out the AI boom, this is the AI, this is the, the S&P 500. But if you take that AI boom stocks out, this is all you would be at, 38.50. So essentially what it assumes is that the flows into the AI stocks that produce this move in the S&P 500 would not exist if it wasn't for going into the AI stocks. And we all know that's ridiculous. Where there are fund flows dedicated for equities, there will be an area of the market that those fund flows go into. So this is just very presumptuous. Okay, we've talked about this study here before from Ari Wald. You might have seen me post it on Twitter. We've talked about it in our Phenom Group research reports. And what it shows is that the NASDAQ 100 went from being 20% below its 200-day moving average to 20% above its 200-day moving average. The only other times it did that was 1991, 2003, and 2009. 6 months later, the market has been up every single time. 12 months later, the market was up every single time. The average return 6 months later, 11%. 12 months later, 24% for the NASDAQ 100. And yes, by the way, the market was never lower across these time frames. 1 month, 3 months, 6 months, 12 months. It's a lot of positive momentum, folks. You're a great deal above that 20-day moving average. what it takes to do that. What I also wanted to know, because the study doesn't lend itself to understanding the corrections that may have happened in 91, 2003, or 2009 after achieving this this deviation from the 20-day, 200-day moving average. Sorry, 200-day moving average. So I went to the charts. This is the 1991 occurrence. Boom. I mean, there was nary a correction. I think the biggest correction there might have been 4 or 5%. So I went to the 2003 occurrence. Again, here was the move above that 200-day moving average. You could say this might have been a 3-4% correction. Here was another one. But folks, up, and away. You want to stay on board. You want to buy these dips. And here it was, 2009. Here's the move above the 200-day move. And you had a nice consolidation period here, about 5-6%, up, and away. You want to stay on board. I mean, this tells you about momentum in the market. We haven't had a correction in the S&P 500. Now 80 plus trading days, not a 3 to 5% correction. People are saying we're due for one. The market doesn't work with due dates, doesn't have an expiration. Nonetheless, it is relevant to understand that the probabilities increase the further you go without having a correction. The probabilities of having that correction increase. This is the updated cycle composite index from Ned Davis Research also. I mean, we've been tracking very well since the beginning of the year. We got off to a bit stronger start than the composite itself. The S&P 500 is the dotted line. And then we had a bit more of a correction. So, we mean reverted right to the cycle composite index. And we're still tracking the same path. We had a bit more of a surge here in June, but it says in July things may stall and get reignited in the tail end of the month before basically very flat, choppy period in the summer, late summer, fall months, and then the liftoff in the Q4 period. We'll see if we can stay on course, of course. See what I do. All right, this is what, you can talk about recession till you're blue in the face, but if the consumer finances or the consumer balance sheet is strong, they are going to spend. If they have jobs, if they have the belief that if they lose their job, they'll easily find another job, they are going to continue spending. Maybe not as robustly as they were in 2021 or late 2020, but they will continue to spend. Here's a look at the total assets of the U.S. households or consumers, if you will. Homes, about 27% of the total. Other tangible assets all the way down. Now look at the liabilities. Main point is they have $168 trillion worth of assets. Liabilities are $19 trillion. That's what you call sound balance sheet, folks. Good luck getting your recession with job market this strong and the health of the household balance sheet, as well as corporate balance sheets this strong. With that being said, I'm Seth Golden. Hope to see you here back next week for our next video. Trade safely, everybody.